Internal Revenue Service IRS tax news. Things taxpayers should know when choosing between standard and itemized deductions. COVID Tax Tip 2021-22, February 22nd, 2021. Deductions reduce the amount of taxable income when filing a federal income tax return. In other words, they can reduce the amount of tax someone owes. So in short, deductions equal good. Deductions good for taxes. Obviously, when we're thinking about taxes, we're kind of in the inverse of where we normally are in the real world. In the real world, we want income to go up. We want expenses to be low. We would like net income to be high. In the tax world, when you go talk to the tax preparer or the tax collector, you're imagining going up typically with, your holes in your jeans and whatnot, and you want to look bad in that situation. That typically means that you would like to have less income if possible, as less as legally possible, and then have more expenses or kind of like deductions, and that would lower the amount of net income or taxable income, which would of course result in net taxes being lower. So we want everything to be kind of reversed for taxes in order to basically owe less taxes. Therefore, deductions good. Now the two major categories of deductions are the above the line deductions, the itemized deductions, and then the standard deductions. So we got to basically get those straight in terms of how those work and what are the relationships between them, especially the itemized deductions and the standard deductions. Okay, so most taxpayers have a choice of either taking the standard deduction or itemizing their deductions. The standard deduction may be quicker and easier, but itemizing deductions may lower taxes more in some situations. Important for all taxpayers to look into which deduction methods fits them. So the itemized deductions are typically more difficult because you have to basically add up all the itemized deductions, and they will typically only be beneficial to you if they are greater than the standard deduction. Now the standard deduction will be different depending on filing status. So when you're looking up your standard deduction, you're saying, okay, am I single? Am I head of household? Am I married? And then your filing status will help you to determine the standard deduction. That the standard deduction was also increased a couple years ago, and therefore a lot more people will be taking the standard deduction, which is kind of good because it simplifies taxes for the most part because everybody just takes a standard deduction. You don't have all this other business with the itemized deductions if that is the case, if the itemized deductions are lower than the standard deduction. However, of course, if the itemized deductions are greater than the standard deduction, then it will be worthwhile from a tax perspective to gather up all the itemized deductions, add them together, and take the greater of the two deductions. The thing that usually drives people over to being able to itemize, and many other things can do it, but the two things, the thing is usually a home, right? A purchase of a home. So if someone has a home, especially a home that's going to be in a more expensive area, a higher cost of living area, California, New York, for example, then the mortgage on the home will have mortgage interest. That's usually the big one that pushes people over to possibly itemizing, as well as the state taxes, property taxes, in other words, on the home as well. So oftentimes the home is the one that's going to kick people over, although some other categories could do it as well. So for example, if your medical costs happen to be really high for 1 year for whatever reason, then that might push you over to be itemizing as well. So that's the general idea. So new this year, following tax law changes, cash donations up to $300 made by December 31st, 2020 are deductible without having to itemize when people file a 2020 tax return. So this one adds a little bit of confusion to the cash contributions, but it's a good thing because normally the cash contributions, you get a deduction for it, and it's a common deduction that everybody kind of knows about, but you only get the deduction if you itemize usually until this new rule, which gives you some deduction without having to itemize. So in other words, before this rule, you would have had to basically have itemized deductions in total greater than the standard deduction being dependent on your filing status, before you get any benefit really from the cash contributions that are going to be made from a deduction standpoint. So but now they got this kind of above the line deduction of $300, and that's kind of not subject to standard or itemized deduction. That's in the other category of deductions that you can then take while still taking the standard deduction, but it's limited to the $300. So if you haven't, if you have charitable donations, you may still be able to benefit from that even if you're not itemizing, is the bottom line. Here are some details about the two methods to help people decide deduction to take. So the standard deduction. The standard deduction is an amount that reduces tax income. The amount adjusts every year and can vary by filing status. So they're going to increase the standard deduction every year. It's the deduction that everybody gets. It's kind of like the floor deduction. Unless your itemized deductions are higher, you take the standard deduction. It will depend on filing status. So obviously the two big filing statuses you would think about are single and married, because those are the two things that would come to mind. Obviously, if you're married, you would think basically the standard deduction for single would basically be doubled in order to not disincentivize marriage, right? You don't want people getting married and then having a tax detriment because two individuals now file the same return. You would think then the standard deduction would basically be doubled. And then you got the head of household filing status, which is like in between, and it usually has a dependent that's going to be involved there as well. So if you're single and not married and you have some kind of dependent, then you're thinking maybe I have the head of household filing status. Once you have the filing status, then you can think about what the standard deduction will be for that filing status and whether or not itemizing is worthwhile, whether or not the itemized deductions might be greater than that standard deduction. So the standard deduction amount depends on the taxpayer's filing status, whether they are 65 or older or blind, and whether another taxpayer can claim them as a dependent. So if they're 65 or older or blind, you might have an added amount to the standard deduction that would basically be on your filing status. And if you can be claimed by someone else as a dependent, then that can have an impact on the standard deduction as well, because obviously they're getting a benefit from claiming you or claiming someone else, claiming dependent on the tax return. So taxpayers who are age 65 or older on the last day of the year and don't itemize deductions are entitled to a higher standard deduction. Taxpayers benefit from the standard deduction if their standard deduction is more than the total of their allowable itemized deductions. They can use the interactive tax assistance, how much is my standard deduction, to determine the amount of their standard deduction and if they should itemize their deductions. So you can basically look up the standard deduction. They have a tool here, how much is my standard deduction, which will help you to calculate it as well. You can look up just the standard normal, what's the standard deduction per category. It gets a little bit more confusing if you're over the 65 or blind or whatever, those categories, because then you're going to have to make an adjustment to the standard deduction. So if you're in that situation, or if you fall into that category, then you might want to use this tool to see what the standard deduction is. And then when you're planning your tax preparation, you want to think, okay, is it even worthwhile for me to go through the itemized deductions and pick those items up? Or, am I not even close? And I should just take the standard deduction and move forward. If you're not itemizing as well, just realize that your tax return is probably far simpler than a tax return than if you were itemizing. And therefore, you might be able to do it with the free file software tools that you could find on the IRS website. If you are itemizing, then your tax return is more complex, probably your income is higher, and you might want to think about tax preparation help, not just to make the tax return, but also to do advice in the future. So itemized deductions, taxpayers may itemize deductions because the amount is higher than their standard deduction, which will result in less tax owed or a larger refund. In some cases, they not allow to use the standard deduction. So the tax software can guide taxpayers through the process of itemizing their deductions. Taxpayers who itemize file Schedule A, Form 1040 or 1040S are itemized deductions. So there's a link to the Schedule A here. So if you're filing the Schedule A, if you're using tax software, it will go through the interview type process to help guide you through the tax software. Although again, if you are itemizing, then your tax return is probably substantially more complex than someone who is not in most cases. And you might want to think about, getting a tax preparer's help just for the advice on those itemized deductions or just the more complex return. A taxpayer may benefit by itemized deductions if any of the following apply to their tax situation. They had large uninsured medical and dental expenses, and that might be more the case in 2020 than in prior years. So the medical expenses actually has another hurdle that typically you need to clear before you're itemizing. So it's kind of a weird one, but obviously if you have a situation where your medical costs were high in a particular year, you want to look into itemizing, because that could be a situation where you haven't itemized before and you have this unusual situation, this unusual spike that could result to benefits from itemizing. So that extra hurdle is basically there's an AGI limitation on the medical expenses category within itemized deductions. So now your total itemized deductions, of course, have to still be greater than the standard deductions, but you're not going to get any benefit even going towards the total on the itemized deduction of medical expenses unless they clear a floor that's going to be based on your adjusted gross income. So that means if your adjusted gross income goes higher, then you're probably more likely to itemize in total, but you're less likely, you're not going to get as much benefit from the medical expenses because there's this floor that you got to clear before you get any kind of benefit from the medical expense. So it's kind of a funny situation. Tax software will really help, and if you put the calculation in the tax software and take a look at the Schedule A, then it'll become more clear what's going on there, and you can figure out what's going on with that. So paid interest and taxes on their home, that's usually in normal circumstances the big one. If you have a home and you have a loan on the home, like most Americans do, if they have a home, they got a loan on the home, they're paying interest on it. Mortgage interest is typically deductible. That's usually a huge deduction that could push most people over itemizing. Once you're over itemizing, once now you are itemizing, then all other itemized deductions are things that will now be beneficial to you when prior to that they were not. And of course, the property taxes on the home is another big key thing. So if someone owns the home, or if you're purchasing a home, then you're thinking, okay, now I might have to be itemizing, might have to take advantage, or it might be a good thing to itemize. Had large uninsured casualty or theft losses, made large contributions to qualified charities. So again, the charities are probably another one that under normal circumstances isn't the one that's going to be pushing most people over. But if for whatever reason there's a large amount of charitable contributions, which could be happening in this current year, then even if you don't own a home or something like that, if you combine the charitable contributions possibly to medical expenses or something like that, those might be large enough in and of themselves to put you over the threshold to then be itemizing. If the charitable contributions are not over that threshold, then remember that you may still get that $300 at least amount, on which is basically an above the line deduction, even if you are not itemizing, even if you're taking the standard deduction. So individual itemized deductions may be limited. Schedule A, Form 1040 or 1040 SR itemized deductions can help determine what limitations may apply. So more information can be found at the links below. Publication 501, Dependents, Standard Deductions and Filing Information, topic number 551, Standard Deduction. There's links to those items here. There'll be a link to this in the description.